morning, folks. I'm Mark Dutram. Welcome to another episode of BayView Views. Today, I'm going to try to help our clients that, or even people that think they can market time, right? So we're going to show you something today I think is fascinating in the data of how quickly the market moves and how it reacts to just events that are happening. And again, it's quite timely today with certainly the volatility that's going on with the Fed and in the markets. And then we want to just clarify the difference between, the market itself and the current business cycle. The market is a forecaster, right? So it is going to be back before the market is, and it's going to be down before the economy goes down, right? So these things are very important. So hopefully this helps. And again, we'll kind of go through some of this data. Then we're going to look at a little bit of a case study, maybe for 2020 and then 2021, and we'll see how this pairs out. So we all remember the business cycle, right? So we go from a peak to a trough, right? So in the economic expansion, things are going well. Then we go into a contraction, into a trough or a bottom, then back to expansion, and then back to another peak, right? So what's important is what I'm trying to show you is average rates of return during this business cycle. And remember, it's not directly correlated, the market. And remember, this is the key thing to remember, is that you don't know when that peak's going to happen or when that trough's going to happen until after, right? Then it's easy to go back and kind of Monday morning quarterback. What's really important is, remember, is this. So the average rate of return from the peak to the trough is about a negative 0.05% per month, okay? And then the average rate of return for the expansion is 1.2%, right? And then the average of all months is 1.04. So this is really important because what is the length of time from here to here? Guys, it's only about 10 months, right? Which is pretty incredible because that's fast. What is the period of time from here to here? It's about 70 months, okay? So really important that this happens very quickly, and again, we don't know, and the market is a forecaster, and is doing exactly what it's doing now as the Fed is trying to intentionally destroy demand, right? So remember this. So the average rate of return for all periods is about 1.04%, and we know that because the market is actually in positive territory. So let's dig into this a little bit. Let's break this down a little bit further. And now we're going to look, remember, we look from here to here. Now we're going to actually break this into fours, right? We're going to break this down into two categories on each side. So that means this one, so economic peak and the market is going down, is about 5 months. That means this is about 5 months. And then this would be about 35 months. And then again, another 35 months, right? So very quick. Now, this is really important. So guys, what's the average rate of return during this initial 5 months of a declining business cycle, right? If the market is in correlation to it, is minus 2.25%. So most of the return, the negative returns, are going to be in this initial 5-month period. What about the next periods? Look at this. So remember, we went from here to here, -2, but look at this next 5-month period. We regain most of it because the average rate of return then is positive 2.15%. And then when we break down this period again is 1.36 and 1.03. And remember, the average of all of them is about 1.04. So this is why we cannot try to time the market, is we don't know when this is going to happen, and the returns that are negative and very consequential happen quite quickly in that first 5 months. Very important that we can actually see that. And then it reclaims it very quickly. So this is even before it started back up. Some of your best returns are even before you hit the trough of the business cycle, which is really incredible, right? When you think about it. So remember, we can't time it. We don't know when these are going to happen, and it's easy to look back and see when these cycles are. So let's kind of look at this. This is all periods now, right? So if we take a look and we just say, what's the likelihood of the next 100 days being positive? right? So this is all periods, whether the market's up or whether the market's down. We can see that 70% of the time, the next 100 days is positive. And we like that because we know the market is up generally 70% of the time. And then we have about 30% of the time where the market is actually negative. Okay? And this is going back now, again, from 1926. So this is a lot of data for us to digest. Well, what if we looked at that same chart after we've experienced a 15% decline in the markets? So now the market's off 15%. What's the likelihood the next 100 days will be positive or negative? Very similar. Remember, we went from 70% to 62%. And then again, we went from 30% to 38% on the downside. And the average is higher, right? Because actually you're buying at a lower price at that point because the market was off about 15% or greater. So the average return is about 4.75. And again, the key is we don't know when these bottoms are actually going to happen, guys. All right, so let's look at kind of a case study here. So 2020, we saw an unbelievable amount of money, about $1 trillion. When COVID happened, people just, we called it a flight to safety. So what this is showing is that on February 26, about $9 billion flowed into money market funds, okay? And then 53 billion, 94 billion, 249, all the way to the peak, selling $345 billion and all the way through. So how many of these guys got it right? How many times was it beneficial for them to actually cycle out of the market? And this is really telling because we can only see that 2 times. In other words, these first 2 folks that ended up getting out of the market actually did any benefit. The rest of them, it hurt them by trying to get out of the market. So we know that. You would have had to have been very early on that. And again, we know when COVID kind of had its peak that's happening. So the flight to quality doesn't pay off. We know that. So let's look at, again, 2020. We can see that, again, this peak outflows. So all these green lines are flows into the money market accounts. As the market is having its massive amount of declines, this peak time of flow, that 345 some odd billion coming out of the markets, right at the market bottom. And of course, what did the market do this year? Finished up 16%, which is incredible because, again, you see a lot of bad news that we saw in 2020. Well, what about 2021? So 2021, again, we had, remember, protesters storming the Capitol. We had COVID cases past 20 million. We've had, again, Evergrande issues in China. Again, we had a lot of bad data, actually, that happened during 2021 as well. And through that cycle, again, lots of ugly news all the way up. But what's important is, what if we break it down? What if we look at this? So here's back to our averages again. Look at this. Even in 2021, when there's a lot of good data, the 43% of the time in trading days, the market was down. Again, 144 up days, so very similar in that massive amount of data between up days and down days. Best day up 2.3, worst day down 2.57. Biggest drawdown was 5. We had 70 all-time new highs. And then again, the market cap went from 33 trillion to 42 trillion in a year, right? And in a year with a lot of bad data. So that's the key, guys, is that markets move very fast, and we cannot try to jump in, jump out. If anybody told you they could, you need to run in the opposite direction because they don't have that crystal ball. But we're trying to help you guys do that. Let's stay invested. Let's stay to our goals that we actually had. And you'll be a much better investor, a much happier investor. Because again, you're going to get this. You know, again, 70% of the time the market is up. We need to actually, that's the price we pay for getting those type of returns. Guys, this is another episode of BayView Views. I hope it's taught you some actually good data about markets and how fast they move. But happy investing to you. If you have any questions about anything, please give us a call, and we appreciate you. Have a great day.